Okay. Oh, okay, Elm. What do you want to trade? Like, what do I got going now? So I have 325 pips. S&P 500, silver, and Hong Kong stock market. What do you want to? NASDAQ and Dow. Oh, dude, that's easy. All right, so cool. Okay, cool. All right, are you a bull or a bear? I mean, I've already done all this, but I can't remember if I did it earlier today or not. Okay, let me show you. This is the 21 EMA on the 4-hour. Let me show you. Okay, great. So I analyzed this hours ago. I'm done. All right, what else? I've already done the process. I did all the work. I did all the analysis. I've analyzed it on multiple time frames. I've already done a video on it. Have you guys seen youtube.com/quantbox? I think I did it here, right? Oh, and there's the new calendar. We had a question about the new calendar. That's yesterday. Oh, this one. Cool. Turn your notification on. Ba-da-bing. You can watch it in 35 minutes. There's the process. But you have to understand that there's a lot going in there. Are you a bull or a bear is the most important thing. So let's do it this way. Do you consider this a lower low? Okay, if you see, let's say that is support, then you probably would identify that as a lower low. Okay, so now you have a breakout strategy. How do you trade a breakout strategy? Breakout strategy. Step 1, or opportunity 1, kick it off that moving average. Opportunity number 2, kick it off that moving average. Done. Okay. Okay. Yeah. Now, if you zip over, it's more obvious on S&P 500. And on one of these charts, I have the annual. So like going from memory, our projected high for the year was like this area. That was our projected high in January. Okay. So anyways, then what? Then the market makes a lower low off of resistance. What did I tell you back then? Head and shoulders. Okay, look at. You were prepped for that. It's a standard operating procedure. But anyways, at some point, there's definitely this. Okay, and then down. So the issue we're having now, Elm, basic technical analysis. Again, all of this is taught at Investor Bootcamp. Okay, this predicts that. So we're already done the month of April. It's done. Okay, this is a top. This is the target. We're done. So there's a bit of a danger here. Okay, normally you do something like this, or normally you do something like that. And that's why this is all plotted. And this is still a resistance area, so it's almost preferred it goes at that high. But nonetheless, we don't know what's going to happen, and nonetheless, this is bearish. In scenarios where this hits early in the month, and that it's about, I guess we can call that the 16th. 16th is kind of middle. If it happened on the 9th, I would have thought that this would come all the way back here. And it might. But I wouldn't call the 16th early in the month. So something like this is possible, but less likely. So I think there'll be less profit taking by the bears. And if anything, more would enter the market, right, Al? So where would they enter? Well, okay, this moving average is a maybe. This moving average is a maybe. But not where they are now in the future. So really this price and probably about that price because this is going to continue down. Okay, then the next theory, using pivot points. If they were locked in, where's next week's sell? Right there. Where's next week's sell? Right there. It's the same two prices. So now we have a zone sell between the 5 and 21 EMAs around 151, which is not far from where we are now. And so, are you ready, Elm? Something like that. Okay. And exit right around 5,000. So let it go up for a day or two, closer to 51, and then take it down to 5K. Well, Sky Killer, maybe he's one of my clients. Okay. How would you grade that, Elm? 10 being the best, 1 being pathetic. How would you grade that? Elm? Okay, so what part is missing for you? Let's keep going. Let's keep building on this. It's not an argument. I'm like, how? It's more like if you were my client, you're like, okay, I see it technically, but I have some other concerns. Bring it up. Let's do it. Let's go. Right? Hoo-ha! I ain't... what's he saying? I'm just getting warmed up. Remember Scent of a Woman? You call yourself a bird man. How do we bump this up? I'm not a 7. I'm a 9 to 10. You get... right? 7 is unacceptable. Let's build. Let's build on this, Elm. Okay. Unpredictable unemployment claims tomorrow. Why? It's totally on trend. Markets don't seem very stable at the moment. No, we just hit the profit target. That's what I'm saying. I think it's just very hard to make long-term prediction. Really? All right. Well, let's remedy that. All right. Let's go to. All right. Let's bring it up. Let me drag this across. Okay. So let's take a look at smart money using the Fed funds futures market to analyze through negotiated in billions, tens of hundreds of billions of dollars in negotiated cash contracts between banks. Let's take a look. We are currently at, where's the rate? Where's the current rate? Current. Okay, 5.25 and 5.5. So right now, there is, as far as the May 1st meeting, there is only a 1.6% chance of a change in interest rates, but that changes a rate increase, not a cut. Okay. All right, well, we'll look at this. And a month ago, there was a little bit of hope of a cut, of a cut. Okay, let's go to June. 1 month ago, okay, there was a 55% chance of a cut. This was actually quite a bit higher 2 months ago, 3 months ago, 4 months ago. 4 months ago, this was probably close to 100%. Okay, Elm? And now there's only an 18% chance, 19% chance of a cut. It's gone from like 80% to 20%. Then we go to a September meeting. Okay. And, well, it's dropped very, very significantly as well. What I'm getting at is as you go through, okay, these numbers are changing. When they cut and the number of cuts are changing dramatically. Why do I bring this up? Well, first of all, these are based on prices of paper being traded, money being traded between banks, smart money, trading with smart money. And they're negotiating the cost of loans to each other, and which is normal. This is totally a normal market. It happens all day, every day. But the prices reflect future interest rate expectations. And we were at a point where there was 100% chance the Fed would be cutting certainly by June and then continue. And now we're at definitely not going to happen, and maybe only 2 cuts this year, maybe only 1 cut this year, maybe even no cuts this year, which was unthinkable 3 months ago. So when you look at the stock market and you look at how it rallied in the previous period, this was all based on money becoming cheap. This was all based on the stock market, or sorry, the Fed cutting interest rates. And you get a scenario where you get the expected return of a stock is equal to the risk-free rate of return plus the beta of, okay, the expected return of the market, S&P 500, okay, minus the risk-free rate of return, which represents the opportunity cost. Okay? And when we talk about the Fed cutting interest rates, okay, there was a reasonable chance they were going to cut here, and a reasonable chance they were going to cut here, and a reasonable chance they were going to cut here, and a reasonable chance they were going to cut here, or some variant of that. Okay? And cutting here, right? Some variant of that, whether it was 1, 2, 3, 4, 5. Remember, they were going to have 6 cuts this year, and then it was 5, and then it was 4, and then it was 6. Okay, and then now it's almost like none, right? So the thing is, as the market was going up, we were assuming, oh, it's going to be 6 cuts. And then they're like, well, it's not going to be 6, it's going to be 5, but that's still pretty good. And then it's not 5, it's 4, and it's not 4, it's 3. And now we're getting to the point where there's maybe no cuts. And there's a big change here because what we're talking about is the risk-free rate of return. You could substitute like the Fed funds rate, or very often this is the yield on the 10-year T-note, but they're related. So when the Fed cuts, the yield on the 10-year falls too. Okay? So what happens is as this RF number falls, okay, by just simple mathematics, the value of a stock rises. And all these cuts were expected, so money was going into the stock market. And now we get to the point where, like, oh crap, we priced in all these cuts. And now they're not going to materialize. Our models are wrong. These stocks are too expensive because taking them out is equivalent to raising interest rates back up again. And if the risk-free rate of return, or sorry, the risk-free, if the risk-free or the Fed funds rate has to be repriced back up to 5.25, then the value of the stock market should be lower. And we've entered a period here where I'm sure you know, but Jay Powell did a conference yesterday with the Bank of Canada, or in relation to trade with Canada. And he said yesterday, in so many words, it's been interpreted, that he kind of admitted he was wrong, that there were still 3 more cuts coming this year. And now we got to price them out, which is kind of like saying, if the Fed's not going to raise in June, but they're going to cut in June, they're going to wait to cut in September, which means now there's only 2 cuts. It's just like, as of yesterday, the Fed just raised interest rates because you have to take out the June cut. And when you raise interest rates or remove the cut, which is the same as raising, then the value of stocks falls. And fundamentally, the head of the chair of the Board of Governors, the Federal Reserve Banking System, and the chair of the Federal Reserve Open Market Committee just said down. So we incorporate that into our fundamentals. And you also see that happening in real time in this market too. The money market, basically. Think of it that way. Interest rates are shifting to the right. Okay? September, things shifted to the right. But what I mean by is we're at 5.25 to 5.5 now. And going out to September, there's a 30% chance, 31% chance, a 1/3% chance that the Fed still doesn't cut by September. Forget June. They might not even cut in September. Oh my God. The stock market's overvalued. The economy is good. It's not an economic thing. The market, the price of these assets is too high. So then you go into like, Well, that's cool. I guess I should sell. Oh, I did. I did sell. Okay? So, Elm, you have to understand, well, first of all, we've talked about this for weeks, so I don't know if you were here. I've set this up over the period of weeks, not hours. Weeks and days. I've had dozens of conversations in regard to all of this thought process. I run Investor Boot Camp. We talk about it in the day trading group. We talk about it in the swing trading group. I run the Council of Investment Advisors, where we've talked about that, and we've set it up, and we're actually trading and building and constructing portfolios to manage this. I just did a 45-minute to 1 hour discussion on how to hedge, so on and so forth. So Elm says, so we can expect a good drop. Well, when you add seasonality, okay, when you add seasonality, let's go here. Okay, we can add seasonality to the S&P 500. What I said in January, okay, 100 days ago, okay, Elm, I charged $4.44 for this knowledge. I said typically there's a shape to the market. This year is going to be different than the normal year. It'll probably have the up happen early, and then a collapse and no recovery until November. And therefore, once we have our early, okay, Q1, Q2 peak, I know the time, Q1, Q2. I don't know the price. But there, if it peaks, okay, or when it peaks, my screen froze. When it peaks, there we go. When it peaks in the early year, it could therefore fall for 6 to 9 months. Whoa. Yeah, I said that 3 months ago. So your big question is, did it peak already? Okay, our summer peak, which usually happens more like June, July, may have peaked now and may not recover. And I said in January, the third week of November is the new up. Okay, not September and October, middle of November. Oh my God, so if this is our peak, if we just peaked. So you're like, dude, so it could expect a good drop? Oh yeah. A crash? Oh, I don't know anything about that. I don't know the velocity, but I do know the shape of the market. And I also understand that we not only are we trapped in a retreating Fed policy of dovish to hawkish, but we also have the fourth year of a 4-year political cycle. And I've incorporated that into my analysis too. So when I say I might want to sell a lower high, I have all of this in mind because I've thought about it for 1,000 hours. I know exactly what my intention is. And I can tell you the logical prices. Now, some of these prices shift a little bit if it's a moving average or an unlocked pivot point, but I can roll with it. I got some finesse. I can roll, right? I can adjust in real time, but my strategy does not change. I just adjust tactically in the fog of war. But I'm an ass kicker, okay? I'm not a 7, okay? Harvard put me through 5 years of examination and said I was one of the best at their little university. Yeah. Love it. Not a 7. So when I'm like, I'm thinking about selling here or here, oh, that's somewhere between 9 and 10. Whether it works out is irrelevant because things change. But we know things have changed recently. As of even yesterday or a while ago, we started getting changes in things like inflation. So on on February 13th, I became a bull on gold. I had been a bear on gold for 2 years. I used to laugh at people for trading gold. I'm like, that's the dumbest thing ever. What kind of knucklehead would want to buy gold when inflation's falling? There it is. Sorry, February 19th is the day I became a bull on gold. That's the day inflation started to rise in the United States. And then it did it again. And then it did it again. And that is bad. And now that as the world is starting to incorporate this new data of badness, we go from no underlying intrinsic trend to definitely risk off. Okay? Yeah. Okay? Now, it says here bearish on gold. That's normal. But we don't have that situation. But I am buying dollar and I am buying Swiss franc, so that's good. But I'm buying gold because it's not an economic phenomenon. It's an inflationary. When you have slow growth and high inflation, you sell your stock and you buy real assets. So you get out of financial assets like the stock market and the bond market, and you buy things like real estate and gold and beef and wheat. Because you can't eat your S&P 500 index. You have to sell it. If your children are hungry, you have to sell your S&P 500 to get cash to buy food. So guess what? S&P 500 down, food up. Cool, right? I know, a little bit of a bully, I know. But we're looking at now how banks are behaving. This is not a survey. This is money, the mid price of these contracts and the derived interest rate of these contracts. And the change over time and the direction of the change over time gets me to do things like sell the stock market, buy dollar. That's sweet, right? Or I look at changes in the VIX, changes in gold, changes in yield, change in the stock market, change in the dollar, change in the yen. Look at them on multiple time frames and take the correlation of all of them. Right? Like, yeah, dude. Yeah. Okay? So I go over that. If you want to see another version of all that information and more, I already did a video at 6:30 in the morning on this. Dude, it's like practically lunchtime. Okay? Okay? Cool. All right, Elm. Did I get it higher than a 7, Elm? Come on, Elm. Elm. Elmy. Elmer. Alhambra. Well, Michael, let me ask you this. Michael brings up an astute follow-on question. So if inflation was stable and GDP, okay, was fine, let's say at 1.8%, and inflation is at 2.2, what about gold? Well, you can own some gold. It costs you money to store it, and it pays you no yield. So all you have is capital gains. But there's no reason to buy it. Thank you, Elm. Thank you. I appreciate that. All right. Okay. So why do you want to own gold? You think it's going to go up. Okay. Why? Okay. There's no reason why. That's the issue. Okay. Now, if you want to know why a central bank would buy the gold to push up the price, you need to know about monetary policy. So you join Investor Bootcamp, you pay the $88, you start the training course, and by hour 3, I'm teaching you how to manage the balance sheet at a commercial bank. And if you know how to manage a balance sheet as a banker, then I can then teach you how to manage the balance sheet as a central banker. So now you'd look at the gold market and say, well, what would be the reason for a central bank to buy a gold or maybe sell gold? Like, you'd have to know what the objective of the monetary policy is and how they would execute maybe gold as part of their strategy. Most people that blurt out central banking when talking about gold have no idea how to run a central bank. So they're just doing some YouTube guru babbling. All right, so we go away from that. What would you do if the economy was slowly growing and inflation was under control? So we have decent productivity, low inflation. Well, you'd probably want to own financial assets. The stock market would likely to be going up. Companies are profitable. Consumers are happy. They're buying new iPhones every year. And we're just chugging along. Everything's great. Okay. Okay, cool. But what about your gold? It'd just be costing you money. But your house would be going up in value and the stock market would be going up in value. That kind of stuff. It's like, well, if the stock market's going up 10% a year and you're losing whatever your carrying cost on gold. So if you have gold bars sitting in a vault somewhere and they charge you $1,000 a month, well, your gold isn't going to be going up in value. Nobody wants your gold. If everything's cool, nobody wants your gold. So you're just holding gold. The price isn't going up. You have no capital gains, and you're losing $1,000 a month. Well, shoot, you can just put money in the money market and earn 2 or 3%. Why would you own gold? Or you could put the money in the stock market, take some extra risk, and make, between 8 and 12. You can own real estate and have it go up 20% a year some years, right? Between 5 and 20, depending on the years. And then rent it out and have a cash flow. Like, gold would be dumb in a scenario like that, right? You want to own financial assets. Because you could then also employ leverage, like get a mortgage. And mortgages would be cheap if inflation was low. So you mortgage up and you get yourself an apartment building, and your commercial loan for 5 years is at like 4%. Okay. Dude, seriously. And your gold is, you're losing money. So yeah. But then all of a sudden, things overheat. The government overspends. Inflation comes back. CPI goes, right, significantly higher than GDP. Uh-oh. And then maybe the opportunity for gold would change. So there you go. See, it's only money. That's the easiest stuff. This analysis is the easiest stuff of trading. Trading is straightforward. But you have to be able to string the pearls together. But also, you have to have patience and discipline and fortitude to execute the trades. Well, how do you have so much patience and discipline and fortitude? How do you have that kind of confidence to make those decisions? Well, you have to have a ridiculous, sickening work ethic. If you want to get rich now, quit. If you think TRADARS is an alert service, quit. We don't need you. But if you have a ridiculous, sickening work ethic, and you want to develop the skills that will lead to patience and discipline and confidence, get on board the Clue train. Let's go. We're ready. Upward and onward. This is amazing stuff. Don't be left behind. Peace on earth. May the pips be with you. May your profits be above average. Oh, one last thing. That just happened!